Good day, everybody, and welcome to this month's webinar. My name is Bruce, and over the next short while, we'll be spending a bit of time looking at the accounting implications of the current COVID-19 crisis and how that's going to impact on financial reporting periods that are currently underway. I wanted just to start to say that I do believe this is an unprecedented and it is a tragic situation. I know as many of you around the world are listening to this, some countries have been further affected than others, and obviously our thoughts and prayers go out to everybody who's been impacted by it. I always think it's strange to be focusing on accounting at a time like this, but I think we need to just step away from the issue that's happening with the health at the moment of people. And I just want to spend a bit of time thinking about the financial reporting implications that this is going to have. The timing, of course, of this crisis has come an interesting one, where obviously we've got December year ends that are probably being finalized, or for some of you in the process of being finalized. And then of course we've got things like the February, March year ends, even going into the middle of this year's year ends, where companies are starting to realize that this is something that they cannot make no commentary on. And I think the starting message I'm going to give everybody around this crisis is communication, I think, is paramount. I'm going to talk a little bit later about some of the things you need to consider in terms of your assumptions and judgments. But I think the one thing that I wanted to stress to you was that we are in a situation where nobody knows what the future holds. As it says there, this is unprecedented. We haven't got a historic event like this that's impacted on us, and therefore we need to make sure that we're communicating with users of the financial statements as we start entering into that. So just bear in mind that I think the overall or overriding principle I want you all to think about when you're going through this is ensuring clear and concise messages to the users of financial statements to help them understand how this will impact on you. Now, just by way of background, to let you know what has been issued from an accounting point of view, the International Accounting Standards Board has spent some time on this, and they have issued some guidance, which I will refer to, around IFRS 9 on financial instruments, clearly obviously impairment being a big issue there, and around IFRS 16 on leases. To date, no standard setting has taken place. What I mean is that they have not amended any standards or issued any authoritative guidance that will change anything in IFRS at the moment. I would point out that the board meeting in April, which is actually happening on the day that we're doing this webinar, is going to discuss this. So the ISB are going to discuss some potential impacts of this. I know leases is one of the areas they're spending a bit of time on, and they may come out with some additional guidance. But as effectively of the time we're doing this webinar, bear in mind there's nothing authoritative that has been issued. As a result, I just want to point out that means that there really should be no allowance to suspend or amend IFRS requirements. Now, I do appreciate that that's a jurisdictional issue. And many countries I know a number of countries who have been grappling with well, do we suspend certain provisions within IFRS? Do we try and supplement them? My advice to any of you who are involved in standard setting is the answer is no. To the preparers and auditors out there, I don't think at this stage you have any reason to suspend the use of IFRS. I think that if you are reporting under full IFRS, you should continue to do so. There really is no way to depart as a result of COVID-19 from the requirements, and I think that is very important. I have had one person ask me if they're believing that, well, their belief was that the impairment models in IFRS 9 don't really work, and they said, well, can we prepare IFRS and we use IFRS except for, and they mention the following provisions. My view on that is simply no. Just remember, IFRS is an all or nothing framework. What that means effectively is you have to apply it in full, or you cannot claim compliance. At this stage, if you have been claiming compliance, or if it's a legal requirement in your jurisdiction, you do need to continue applying it. So just to point out, there is no basis at the moment to suspend or amend IFRS unless the ISB themselves publish something. Now, there are many areas that are impacted by this, by the reporting in this, and obviously I could spend hours just going through them. And if you go online, there's a lot of great guidance that's been put out there by various institutes, firms, a number of people putting things out there, professional bodies, trying to help out. I just want to focus on some of the key issues that we've been facing. And I think the top four there that I've listed there are the issues around whether something is an adjusting or non-adjusting event. Clearly, impairments is a big issue at the moment. Leases, and then some of the judgments and disclosures. I am then going to end off just touching on some of the other issues you may need to consider in standards, but I would point out that this is not an exhaustive list. It could impact almost any standard depending on the type of industry, the type of business you are. So please have that as a hat on, no matter where you are in financial reporting at the moment. Right, let's start with the first standard we're going to take a look at. And the first one is probably one of the bigger technical challenges we've had, and that's the issues that arise out of IAS 10, dealing with events after the reporting period. Now, just to remind you the key principles here, remember the way IFRS works effectively, IAS 10 works, is it says you've obviously got your start of your period, you've got the reporting date, which is the first one you'll see there, and then the IAS 10 says what companies need to do is that you need to consider any events that happen between the reporting date and, of course, the date at which your annual financial statements are authorized for issue, and consider whether those events are adjusting or non-adjusting events, and it then tells you what you need to do in relation to those. Just to remind you, adjusting events, these are those that provide evidence of conditions that existed at the reporting date. So as opposed to your non-adjusting, which are things that arose after that, we're very much concerned in this situation of what existed at the reporting date, and do we therefore, or do we as a result, need to make adjustments to the numbers we're reporting for facts that have come to light that existed already at reporting date. Obviously, the alternative is a non-adjusting event is something that arose after the reporting date. For example, if you had a December year end and at the end of January your warehouse burned down in a fire, that doesn't change the fact that you had a factory on the 31st of December. But of course, we would say that is quite a material event, assuming it was material, something we would want you to make comment about in the financial statements. So whereas you wouldn't adjust the numbers for 31st of December, we would still make disclosure thereof. Now, this has been one of the areas of technical debate amongst various technical people as to whether or not this COVID-19 is an adjusting event or not. And I think depending on your year end, you may need to apply some judgment. Now, just to use to understand the timeline, the 30th of January 2020, this was the date that the World Health Organization announced that COVID-19 effectively was a concern. So they're saying they named it at that stage a public health emergency of international concern. But the 11th of March was the date that this was declared a pandemic. So I think for a lot of people, they're looking at that March date and saying, well, that's the date we really believe that this was now at a massive area in terms of something that you cannot ignore. So just take those into account as we start looking at the different year ends, and you need to obviously decide which of those you believe would be more important. I would point out that different countries declared it an emergency at different dates. So please, these dates aren't the ones you have to use. In various countries where this was declared a national emergency or whatever your country may term it, or lockdown or whatever they've decided they're going to do, the dates may be slightly different. But I've just used these as kind of general guidelines to illustrate the type of events that you need to be looking at. Now let's look at the example of the current year ends we're dealing with. If you take a look at the dates that are put out in front of you on the slide there, I think you'll all agree that December 2019, most people generally feel that at that stage, when we got to 31st of December 2019, yes, the virus existed, but we all believe that this was a non-adjusting event at that stage. The reason being, it wasn't a global pandemic. It hadn't been declared even an area of concern at that stage. And I don't believe that this would have impacted on any companies at the 31st of December had they literally reported on the 31st of December. So I think most people agree that for the December year ends, we would see the COVID-19 or any impacts of that being a non-adjusting event under IAS 10. On the other side of the scale, I think if you're dealing with a March year end, everybody agrees that if you had a 31 March 2020 year end, this would clearly be an adjusting event. I think by that stage, this had been declared a pandemic. I think most people accept that it was out there. So I think anything after March, so March, April going forward, I think you would accept that this is an adjusting event. It's clearly something you had information about. We knew it existed at year end, and therefore you would need to consider whether any adjustments need to be made as a result of that. The period in between is the one that's a slight difficult one. And that is, of course, if you've got your January or February year ends. And this is completely an area of judgment. The question I always like to ask is the one that I've listed there. Do the events give sufficient evidence that the conditions existed for the entity at that date? So what you need to ask yourself is, at the 31st of January, for example, in your country or your jurisdiction, was there enough evidence that this was a major issue at that date? This, of course, I think will be country specific. At that stage, some countries in January and February, this was already a major outbreak. Governments had declared emergencies and it was a challenge. For other countries, this only happened at a later date. So I'll point out that I think for your as I said, in that scale there, December year ends, you're okay. This is a non-adjusting event. I think from your March onward year ends, this would clearly be an adjusting event under IAS 10. However, for the intermediate period, you will need to apply your judgment and justify that in terms of what's happened within your country. I don't believe the ISB or anybody are ever going to give you hard and fast rules on this. I know in some countries the national standard setters and the professional bodies are trying to steer people one way or the other. I think I'd suggest that you look at the guidance that may have been issued within your countries. But I think if you are sitting with something like a Jan or Feb year end, you'd probably have to do a little bit more disclosure, a little bit more work about making that judgment call as to whether this was an adjusting or non-adjusting event. Whereas I think for the earlier and later year ends, it's not going to be. Just remember there is one exception to this, and that of course is going concern. Remember that if the going concern assumption becomes inappropriate at any point, so even if it's after the reporting date but before you've approved the financial statements, that is one there of course that you would then not report on a going concern basis, and you wouldn't be using a going concern assumption when you prepare your accounts. And I think that is quite important. We're seeing in the press at the moment a lot of companies starting to hit a lot of financial challenges. I think especially if you're in retail or in entertainment or those type of things, not just them, I think many companies are. And I would suggest that if, especially for the auditors out there listening, there probably needs to be a greater focus at the moment on going concern. And even within the company signing off as going concern. So I think people need to spend a lot more time on it than they probably have in the past, just given the situation we're in at the moment. Remember, of course, as I said, this is regardless if it's an adjusting or non-adjusting, if the going concern assumption no longer appears appropriate, you cannot prepare the accounts on a going concern basis. Now, obviously, IFRS doesn't tell you what basis you then do, and there's a lot of guidance out there on what you can do, a breakup basis, a liquidation basis. There really isn't any guidance because IFRS requires it. But I think if you or your clients are in that boat, obviously you need to be having some slightly more serious discussions around what you're going to use. So that's the first one. And I think that the guidance, I think, is out there for the, as I said, the December, March guys, the other guys. Just use a bit of judgment, disclose it, and let people know what you've done. The second area, which I think comes as no surprise to anybody, is the area of impairment under financial assets. Now, we're all still getting to grips with IFRS 9 and its new impairment models. I think if anybody out there said we're 100% behind it, we understand it completely, I'd say well done to you. You're definitely in the minority of people. We're all still trying to understand the impacts of this, and for most companies, they're refining their models. They've been through their first year end. Maybe they've now been through their second year end on it, and they're just starting to see the output. The problem with this model is that if you take a look at I'll start off talking about the general model. The general model really works on the basis of saying, look, we need to see, have there been any significant changes in the credit quality of the financial assets we have since initial recognition? And a lot of that, of course, remember the change from IAS 39 to IFRS 9 required you, instead of looking backwards with a retrospective approach, in other words, an incurred approach, to look more at a forward-looking approach. What do we think is going to happen in the future? Now, that may have worked up until the beginning of this year. And I think for many companies, they were getting to grips with understanding what are the macroeconomic factors they need to feed into their models, how are they dealing with them. And then COVID-19 has arrived and has really kind of thrown a spanner in the works. And I think the reason for that is quite simply companies don't understand the impact going forward. We do not see how this is going to impact us as we start moving into a new world. And the problem with that, of course, is we don't have any credit history based on what this will happen. So there's nothing for us to look at in the past. There's nothing for us to be able to compare this to. And I think as companies start trying to get to grips with that, that's where I think we're going to see just a little bit of a challenge with everybody trying to get to grips with it. So what I want to do is I want to talk a little bit about how we actually apply IFRS 9 in this world. Now, I did mention to you, of course, that the ISB had issued some guidance, and a little bit of that's been incorporated in what I'm talking about. But as I said, there hasn't been any major change to the actual standards. Now, the first thing to ask yourself, of course, is in applying IFRS 9, it always says to you, has there been a significant increase in credit risk? Now, remember, the ISB doesn't give us any bright lines in IFRS 9. So it doesn't say it's got to, the risk has to have increased by this level or that level. This is an area in judgment. And what you needed to do is you need to obviously go out and look at what do you believe it was going to be. You need to come up with some policies around that. And of course, you had to look at what was reasonable and supportable information you had available to you without undue cost or effort. So they didn't expect you to go out there and hire a team of credit analysts if that's not what you did. Obviously, the banks would have had that in place already. But you need to look at past events, current conditions that existed at the date we're at now, and of course, the forecasts of future economic conditions. That's the one that's creating a bit of a problem. I think the past events is easy. We know what our historical credit losses are. We know what some of those are. The problem is trying to then take that information, adjust it for the current conditions we're in, which are unprecedented, and then forecast future economic conditions when we really don't have any models to help us with. That's going to be the problem because we're still in early days of the crisis, which means we don't know what's going to happen. For most countries at the moment, we don't know when the lockdowns are going to stop. We don't know when economic activity is going to resume. We don't know how many companies will still be around. You could have loaned companies money that were looking very strong in December last year. Right now, you actually don't know how they're looking because the reality is you just haven't got any information on how this is going to impact them. So I think everybody's accepting that this is going to prove a big challenge. I think the starting point to point out is that the models that you've created under the general model, and the ISB went on to support this, that the models are not invalid. So we're not saying take your IFRS models that you've developed and throw them out. We're saying use those models as a starting point because those were still built on the information you had, and I think they make sense. Secondly, I think you need to understand that just because in some countries there are payment holidays, this doesn't necessarily mean that there's a significant increase in their credit risk. So, for example, if I've got certain types of receivables and we've decided to give them, well, we used to give them 30 days, they've now got 90 days to pay because everybody in the market, or maybe there's even a government requirement, but there's a need for people to have extended payment terms, that doesn't necessarily trigger an impairment. Remember, all that's going to do is that's going to say, well, yes, I may be giving you 90 days, but I still may believe that you're going to pay me 90 days and that I'm going to get the full amount. So remember, we only move things under the general model from bucket 1 to bucket 2 or bucket 3 when there's been that significant increase in credit risk. Remember, payment holiday doesn't necessarily trigger that. Thirdly, of course, I want to point out, as I did earlier, that the ISB has reiterated that you cannot suspend the IFRS 9 requirements. And I spoke a little bit about that earlier. And as I said, that was reiterated in the ISB's document. I think in applying the IFRS 9 model, a few things to take into account. Firstly, it can't be business as usual. So you can't just say, well, we're going to continue to run our current models. You need to consider the macroeconomic factors, the government assistance that's out there, all other information that's been made available, because you probably will need to adjust those models. Now, there's a couple of ways that you can do that. The first thing you can do is you can say, well, we've got enough information to adjust our model to take into account the impact of what's currently happening. That, of course, would be the best idea. If you can, work on the new models, bring in the current conditions, look at the forward-looking information, bring that in, and adjust the model for those impacts. The problem is, and I think this will happen a lot with the banks and with the larger companies, is that it's very difficult to just adjust your model. Some of these models, people have spent 5-6 years developing. They've been running them for quite a while. They're there. And the impact of COVID-19 on those models is going to be very difficult to just anticipate how we can just quickly adjust their model. Also, given that that may not be continuing on. So what we're saying is that you could potentially do what's called a post-model overlay. And what we're saying is run your current model under IFRS 9 as you would. Obviously, adjust for what you can. But then do an overlay. And what I mean by an overlay is do an adjustment that says we will adjust our model to reflect the impact that we believe that this is going to have. I think that's one that could work because what could be nice is you could show people then the model that you're currently running and then say this is the adjustment we've given. Now, ideally, of course, if you're in a jurisdiction where central banks or somebody has given, or some of the authorities have given some guidance as to what type of overlay they would expect, that would be your first prize. Because then you can say, well, we've applied the following overlay to our financial assets using the general model, and this is the adjustment we've come out with. Will it be perfect? Absolutely not. As I said, I don't even think we've ever seen something like this. I mean, if you take the financial crisis we had back in 2008, that was easy. It was a financial crisis. It wasn't easy, but we could kind of understand a bit of the impact of it. This is a health pandemic, which is just impacting every industry, every company globally, almost every country. It's become very difficult to forecast. So I do think that we must understand that there will be great areas of judgment in this. But I'm going to go back to what I said up front. Make sure you've given disclosures around what you're doing. Now that's of course on the three-stage general model, and I don't want to simplify. I mean, we could spend a lot of time talking through those adjustments, but I think what I would suggest to you is speak to your advisors, speak to your auditors early, make sure that you all in an understanding around what type of adjustment you're going to make to those models, especially if you're a large institution, most importantly if you're a financial institution. I think you will need to be spending quite a bit of time taking a look at that. Now, on the other side, of course, remember, we've also got the simplified approach. Now, remember, the simplified approach, as it's the middle block there on the right that you can see, the simplified approach, effectively, this is looking at things like your standard trade receivables. So these are your IFRS 15 contract assets or trade receivables. There's no financing, they're less than a year, or of course things like your lease receivables or your IFRS 15 trade or other contract receivables that did have financing. Remember, there you had a choice for some of them, or some of them you're required to do. But this is where IFRS 9 gave us that simplified approach. It simply said we take a day one provision against our debtors, for example. So how have these guys been impacted? Most companies applying the shortcut method applied a matrix approach. And the matrix approach, of course, there's quite a lot of detail on that. I'm not going to go into that now, but for those of you who haven't looked at it, we have got some guidance in the IFRS 9 impairment e-learning module that you can refer back to. But the matrix model effectively said, look, I'm going to look at my historic losses and I'm going to adjust for current and expected changes in the economic conditions. I would point out that what we've seen is very few companies did a lot of adjustments for the current and future economic conditions. Why? Well, because these didn't change much, which means it wasn't really material to them. And what most companies have done is they've used the historic loss information and said there's no material impact, we've assessed it, there's no material impact of current or expected changes in the economic conditions, therefore we believe that the historic is the best estimate. Hoping by now you can see why that's not going to work. And that's not going to work because I think it would be a very, very hard sell to convince me that for your trade receivables, for example, the current and expected economic condition or future economic conditions will not have any impact. I think currently where we are, there's clearly going to be an impact, as I mentioned, across the board, whether you're a sole trader or you're a listed large bank. I think everybody's given an impact of this. And therefore, my suggestion is, I think that for those of you who have been using trade receivables, you will need to come back and relook at your models. Where you haven't done any adjustments for current or future changes, I do think you're going to need to take a look at those. I think something else to point out about those, remember, is that you will need to start saying to yourself, as I mentioned up front, just because people are taking longer to pay doesn't necessarily mean that they're automatically impaired. You will, of course, just need to factor that in to your assessment. Some of the adjustments you made to look at, just remember that your historic losses, these may not be indicative of the current situation. And I think bearing in mind that just leads off the fact that we haven't historically had such an event that's taking place at the moment. And therefore, I think that looking at your historic losses is not necessarily going to be effective in a forward prediction. I think also the current economic conditions, I think most companies will probably be at a stage where you'll already be able to see some defaults taking place that you hadn't expected. So maybe that'll help you in adjusting your historicals for your current situation. Where you've had to give moratorium on payments, whether those were government required or whether you've chosen to give those, I think you'll be able to, or where people have asked you for them, I think that will help you in terms of starting to understand a bit about the current conditions, how those be impacted. We have, of course, had some government requirements. I know in some places governments are requiring payment holidays, they're requiring moratoriums on lease payments, those type of things. Obviously, you can build those into your cash flows to see how those impacted. And of course, you will need to update your days past due categories. So remember, of course, that where you are looking at what are the days past due of your for example, your trade receivables. You'll just need to update those because I think at the moment most people will probably be running a bit past due. Obviously, that's the historic and current. Look at the future economic conditions. You need to look at your expected credit losses. And that's going to be tricky, but I think that you can assess that it's probably going to be higher at the moment than it was historically. Obviously, that can depend in most industries, but I think that I would probably start with the assumption that I would expect to see a higher credit loss impairment, which means I'd expect to see you doing a little bit more on that. Obviously, this is going to be an area of significant judgment because you've got to take account in terms of things like what is your view on the markets, your debtors' financial health, the markets you're working in. Are you providing everything to the to restaurant industries, in which case that could be a challenge? Are you in the holiday and tourism sector, which is obviously going to be very hard hit, the airline industry, or you could be very resilient. You could say we're in a online gaming, which would obviously be a wonderful industry to be in at the moment, with all the kids sitting at home. So obviously you need to look at all those things. The other thing just to point out, I think you may need to look at is you may need to reassess your portfolios. Remember, the one thing that the standard said is you can group trade receivables into portfolios of, for example, debtors with similar credit characteristics. That may have worked in the past, but I think now it's no longer you're going to have to relook at it, as you probably find there will be debtors in there that aren't going to exhibit the same credit characteristics, just given that some of them may be in different market sectors, different industries, different countries that are being harder hit by this, or not impacted at all. So I just think I'd reassess the portfolios to ensure that those are still valid in terms of doing that provision. That's kind of the general and the shortcut approach that you need to take a look at. I do, as I said, if you're out there at the moment in the company preparer side, my suggestion would be I do think you need to consider that this is an area you need to spend a bit more time on. For the auditors out there, I think for you guys, this is obviously a very high risk area, and I would start engaging with your clients a lot earlier than right at reporting date on this. As I said, especially in the shortcut method where people haven't had any kind of real complexity. They've all simplified the way that debtors provisions have been prepared, and now we're in a situation where you may need to relook at those. Just give some thought to that. Some other IFRS 9 considerations I'm not going to go into in detail. Just remember, of course, the same will apply to things like receivables on intercompany loans or intercompany debtors. I know some people forget about those, but remember, if you are preparing the standalone accounts, your intercompany debtors, your intercompany loans, you do need to be providing against. Once again, you may have certain subsidiaries or certain associates or certain other companies within your group where clearly their risk profile is going to change substantially as a result of this. So I think you would need to consider the impact on your intercompanies. Financial guarantees is another one. Remember, if you've been providing a financial guarantee, or if you've been looking at collateral or those type of issues, they may not have been as important in the past as they are now. And of course, if you've got a parent providing financial guarantee on a big debtor, you may not have necessarily been considering the financial health of the parent in any great detail. You may need to reassess that, just given that they could all be in trouble. So just remember, financial guarantee is another area, even collateral, where you'll need to be considering that. The other one, of course, is credit enhancements by governments. We have seen certain governments going out and providing some sort of enhancements or credit guarantees. I think if you are in a country where that's being provided, I think you need to consider the impact of those on there. And of course, fair values. Remember, with financial instruments, we are in most situations in a fair value environment in which you will be providing fair values. Unfortunately, if you are using your kind of level one and you're just using market indices, remember the market indices are on the date of the year end. So if you had a 31st of December year end, you can't say, well, because the market collapsed in the first quarter of 2020, we're going to adjust our December. You've got to take the snapshot at December. So you could have much higher values there that necessarily they've been carried at. Now, the same, of course, if you've got a March year end, you could have big losses. And unfortunately, that's just the way the cookie crumbles at the moment. You're not going to be able to do much about that. The one focus I just want to point out is obviously on your level 3. Remember, those are your level 3 fair values where you'll be doing your own calculations and determining them yourselves. I think you will need to spend a bit more time looking at those, reassessing your market assumptions, reassessing how you've got to those level 3 fair values. Because I think a lot of those level 3 fair values, a lot of those assumptions may need to be reassessed just given the current and expected market conditions. So all in all, IFRS 9, as I said, probably going to be one of the biggest areas that you will be spending a bit of time on. Right, moving on. The next area we're going to look at is impairment, but moving on to the other side of the assets, and that are the non-financial assets. Now remember, very simply, IAS 36 says to us, we need to carry out an impairment when our carrying amount exceeds the recoverable amount of an asset. Of course, recoverable amounts is the higher of the fair value as cost to sell, and or a value in use calculation. You look at those two and you see, of course, if they are supporting the carrying amount of the asset. Now, I'm not going to go into detail in terms of how we do all those calculations. If you do need some help on this, I'd once again refer you back to the e-learning module on IAS 36 on the e-learning platform. But Obviously, you can immediately see that this is going to be a major challenge in terms of a COVID-19 world. In that, if we take a look at those recoverable amounts, of course, the way those are calculated could both be impacted by what's happening at the moment. Now, the starting point to remember, of course, is that when we're looking at impairment, we don't have to do an impairment test every year. Remember, there are only 3 areas where we are required to do an impairment. The first one being intangible assets with indefinite life. So if you've got big brands, big trademarks, things that you've deemed that you cannot determine the useful life for, you need to always do an annual impairment test on those. The second one, any capitalized research and development, or development that is not yet available for use, you obviously need to do an impairment test. And of course, the third one being our good friend goodwill, where you have to still do an annual impairment test on that. I'll just sidestep for that at the moment to remind you that the ISB has currently got a discussion paper out on goodwill, which comments are due later this year. If you haven't looked at it and you have got your company or your clients are heavily impacted, take a read through that discussion paper. And they ask some very good questions and proposes some interesting changes around that. But that's just a sidestep there. So for those 3 items, you have to do the impairment tests, and we'll talk a bit about the calculations now. For the other assets, IAS 36 says we only need to do an impairment test when there is an indicator of impairment. Now, this is the one, of course, that we need to focus on. What do we mean by an indicator of impairment? I think you've got to accept that at the moment, if we took a look at the current conditions, there are clearly a lot of indicators in the market that would highlight to you that you may need to carry out these. And these, of course, are things like decreased demand for products or services. So whatever you may sell or you may provide, if you haven't seen a decreased demand for your products or services, once again, you're in a very good position because I think most companies have. You could have things like cancelled orders happening there. There could be business interruption in your supply chain. Just as a result, you cannot get raw materials. You cannot get things that are vital to what you do. There could be financial difficulties of your customers, in which case you know that their demand is going to drop. Staff unavailable to work. You may have a fantastic factory and it looks wonderful, but because there's a lockdown at the moment and your staff cannot attend, the machines aren't producing anything. There also may be requirements to give payment holidays or concessions to people. And of course, remember, IAS 36 also points out that one around if the net asset value of a company is greater than the market capitalization, that could be an indicator of impairment. If you are dealing with a listed company, that could very well happen, given we've seen a 30-40% drop in value, even more for some companies, kind of across the board. You could very well see companies at the moment trading at a situation where their market cap is below their net assets. Now, this is once again not an exhaustive list. You would need to look at your clients or your company and decide what are the indicators that require we need to do impairment testing on assets. But I would think in the current situation, it would be very, very likely that hand on heart, you're going to see some indicators that point out you need to look at impairment. Remember, the thing here is that if you do see an indicator, then IAS 36 is a pretty prescriptive standard in that it says, once you've seen that, you have to now do the impairment. Remember, IAS 36 is not it's not a wait and see standard. Now, what do I mean by wait and see? I think some people believe that this is a temporary fluctuation in the market. They believe that hopefully a vaccine will come out, hopefully this will resolve itself in the short term, and in 6 months' time, everything will be fine. So why have to do that now? Unfortunately, IAS 36 doesn't do that. It says if there is an indicator, you have to do the impairment test. That's unfortunately there. And once you've done the impairment test, then what you would need to do is you'll do the impairment test, and if the result is there's an impairment, you have to book that. You cannot say, well, management's going to wait and see, or management's going to make a judgment call not to do this. You can't do that. Unfortunately, IAS 36, as I said, becomes mechanical. Once you've been through the judgment area around indicators, then it just says, well, now you do the impairment test, this is how you do it, and of course, if the answer is there's an impairment, you have to book it. So you need to take that into account. Bearing that in mind, what that really means now is that you need to reconsider the cash flows, discount rates, growth rates, etc. you're doing at reporting date in terms of how you've determined your impairment test. Also remember, you can't take into account any potential government assistance. So there's certain things you can't take into account when you're looking at your cash flows, like potential reorganizations or things you may do in the future. One of those things that you also can't take into account here, of course, is the potential of government assistance that may be given in the future. Remember, we make this assessment at reporting date, so you can't say, well, we expect government to bail us out, therefore we're not going to take any impairment. Okay, so how are we going to do this? To start off with, you need to prepare the forecast to support the carrying amounts of the assets, okay? And that is going to be tricky, okay? Because you need to take into account where we're at the moment. What I'd suggest is that where you have got assets, obviously the material assets that now need to be assessed for impairment, go through those cash forecasts and say, do we believe these are still valid? Now, most of those cash forecasts do go out a number of years, which means these are not short-term, which means you're not looking at, you can build in the fact that you believe that there's a short-term issue into the cash flows and you believe that will be resolved. Obviously, that's going to be a big assumption, and if it has a big impact on the number, I would expect to see it as part of the significant judgments that you've made. But you will need to reassess those cash flows looking forward. Of course, remember, any information that you do build into it, you need to decide, is that an adjusting or non-adjusting event that gave rise to that information? We'll obviously take those. Remember, we had that discussion IAS 10 earlier. You will need to build those into your forecasts. Of course, remembering that when you are starting to look at the discounts, you'll need to take those into account there as well. Just remember, there are two ways that we're doing this impairment test. The first way, of course, you look at the fair value less cost to sell. I think that for some assets could be tricky because determining fair value in the current market could be difficult, or it could be easy if you've got a very liquid asset, but you may find that the fair values are a bit lower at the moment than you thought they were going to be because the market's dried up. So just be conscious that you need to take those into account. If you are doing, obviously, the other one where you're saying, well, what we're going to do is we're going to do a four-quarter cash flow and do a discounted cash flow to support the recoverable amount, then, of course, all of this will be taken into account. Just remember for goodwill, if you are doing when you do your goodwill impairments, not are, and you have to do this when you do your goodwill impairments, remember you first need to determine that the assets within the cash generating unit that you're looking at for goodwill, whether any of those need to be impaired. So I think the fact that you're going to have to consider that anyhow pretty much shows, and with the current economic conditions, just spend a little bit more time saying, are we happy with the carrying amount of the assets within that before we start looking at the goodwill impairment. Remember, of course, for the assets, this can be reversed. So if you do end up recognizing a big impairment now, you can reverse that in the future. If the conditions that give rise, a vaccination comes out tomorrow, they give it to everybody, everybody's resolved, business is back to usual, and by June this year, God willing, everybody is safe, happy, and back at work, yes, maybe this will reverse. So remember, goodwill can't reverse, but for the other assets it can. So just bear that in mind, that you will probably need to be considering reversals as we move forward at the moment. Okay, folks, so that effectively is impairment. And as I mentioned, I think both for your financial and your non-financial assets, that to me is probably the one area that's going to impact almost all companies across all industries. So just be conscious that I think you will need to spend a little bit more time on those areas as we move into the reporting periods going forward. The next area I want to take a look at briefly is just IFRS 16 on leases. Now, leases, of course, is a new standard for us. Most of us have just been applying it. For most companies, this would have been the first year end. The December year ends would have been the first that they've really applied this in the reporting period. And for any of you kind of moving into the Jan, Feb, March going forward year ends, yes, this is the first time you would have been doing it. So there is that little bit of complexity in that we haven't got a lot of experience with the standard, and now we've got to try and take a look at how it's going to be impacted by what's happening at the moment. Starting point, of course, to remember is the main issue we're facing at the moment is around the measurement of the liability. Once, remember, the standard says that if you're a lessee, all leases effectively are capitalized leases, so they're all finance leases. So you're going to take the lease, you're going to capitalize a right of use asset, and you're going to recognize a liability on the other side for that. Now, with the liability, of course, once we've recognized it, there are some changes that need to be looked at every year, and that's just what I want to look at a little bit at now and see what guidance we can give you on that. Starting point to remember is that for the financial liability side of your lease, all liabilities are measured obviously every year by increasing by the carrying amount to reflect the interest on the lease liability. You reduce it by any lease payments made. So those two just standard kind of financing transactions. But then the third one says to us that we need to remeasure the carrying amount to reflect any reassessments or lease modifications or to reflect any revised in-substance lease payments. I think the main issue for me is in that third bullet, which says, how do you adjust for lease modifications? Because I think the main issue we're seeing at the moment is around what happens when there's a modification to the lease. The one thing I'm not going to talk about here is I'm not going to talk about the fact that if you're a lessor and your receivable is going insolvent, I'm not going to talk about that here because remember, the lease receivables, themselves for the lessors fall under IFRS 9, and we spoke about the impairment of financial instruments earlier. So you would look at these as part of your IFRS 9 impairment. Here I'm going to talk about it more from the liability side for the lessee. Now, what is a lease modification? Okay, a lease modification effectively is where either you change the scope of the lease or the consideration that is payable as part of the lease, and that these changes result from something that was not part of the original lease agreement. Okay, so just to break that out a little bit more, scope, this would be, for example, where there's a change in the right of use that you're giving to a lessee, or that's been given to a lessee in the lease, and consideration was payments, if there's been any change in the payments. Remember, as I said, these are where they are not part of the original lease. Okay, if they are part of the original lease contract, and these payment, for example, change the result of it, then they are not lease modifications. And IFRS 16 tells us anything that is not a lease modification, we account for effectively as a variable payment. So we take those to profit or loss. Okay, so if it's a change, for example, and a classic example there would be a turnover, a rental. So I rent a shop and I pay 2% of my turnover to my landlord. Currently, I have no turnover to pay him because I've got no additional amount to pay him because there is nothing happening in the shop. The shop is closed. That's a change in the cash flows, but clearly that's part of the original agreement because I was paying a fixed amount plus a variable amount that was based on my turnover. So that would not be a lease modification, and any changes in that would fall into it. What I'm interested here is, what do we do when there is a lease modification? Now, if there is a lease modification, okay, the standard says what you need to do is you need to go into IFRS 16, and paragraphs 44 to 46 effectively lay out the way that you would make the adjustment. So what this means is, for example, is if let's say some economic relief was provided to the lessee. So I said, right, we're going to give you a 3-month lease holiday, for example. So it's going to impact on the payments. This would be a modification, and what I would do is the lessee would remeasure that liability by discounting the revised lease payments by the revised discount rate. So effectively what I'm saying is I would say, well, what are my remaining lease payments? What are the changes? So for example, it's a 3-month holiday. I'll move out my payments for 3 months. And of course, that may mean that my future rentals have gone up by a little bit, or there may just be a cancellation of them. There could be various options we've seen, or they could extend the lease by 3 months. I don't know. There are obviously too many permutations to talk through all of them. But the key thing to point out is you have to revise the lease payments and what that modification has done, recalculate your discount rate, discount it back, and you have an adjustment to the lease liability. Remember, once you've got that adjustment to the lease liability, the other side of that would go against the right of use asset. So you'd adjust the asset and the liability. Remember, of course, if the right of use asset for whatever reason has been written off or no longer exists, then you would just take that adjustment to profit or loss. Okay, so very important, if you have been given a payment holiday or moratorium for the next year, or whatever, they've adjusted the payments, whatever's happened, if it was an adjustment as a result of something that was in the original lease, then this is not a lease modification, and any changes will go through P&L. If it was not in the original scope of the lease, it wasn't something envisaged in the original one, this would then be a lease modification. You need to recalculate your lease payments and make an adjustment against the right of use asset. Just one thing to point out, in some jurisdictions, the government has been providing support to lessees as a result of leases. If you have received a government grant to help you out with your rental payments, remember that wouldn't be a lease accounting issue. That would be an accounting under IAS 20 government grants. If your lessor has been paid on your behalf, so maybe government saying, well, we'll pay your rental for 3 months, whatever. What's most likely happening then is that the lessor is just acting as an agent potentially on your behalf. You'd obviously need to look at that structure in a little bit more detail, but you do need to, these are probably fall more into IAS 20 than leasing. So just to point out, a different standard could apply there. The next area, just to point out that I think you need to give thought to, is the area of judgments and estimates. Now, IAS 1 says, of course, that you need to obviously disclose the key judgments and the areas of estimation or estimation uncertainty that you may have within your accounts. Obviously, where we are at the moment, that's going to have quite a bit more focus than it's had in the past. If you consider the challenges at the moment, obviously the standard says, IAS 1 says you need to select appropriate accounting assumptions, develop reliable estimates, and you need to consider all available information. The problem with that, of course, is that when you look at all of these, this may be very limited at the moment. And I think one of the areas that there's a bit of a concern around is inconsistency. Are we sure that people are all getting the same information? How are people interpreting it? And as I said, the problem could be that I'm a believer that this will be finished by June. Somebody else may be a believer that this is going to go until September, and somebody else may believe we're in for an 18-month financial crisis. Depending on which one of those your company believes is correct, will have a very, very material impact on the adjustments that you've potentially made to your accounts. So I think that that's important. So those are the kind of judgments we're going to have to make in terms of this. And I think I'm going to stress that you need to ensure that the users of your accounts have enough of an understanding on how this uncertainty impacts on the preparation of your financial statements so that they can make appropriate adjustments. What that means is if I'm a user of your accounts and I believe it's going to be resolved by June, whereas you as a company are saying we believe it's going to be for the year, I could then say, well, that's fine. This is obviously ultra conservative compared to what my view is. I can then adjust the numbers for what I believe they should be. But I think to me, the starting point has to be disclosure, disclosure, disclosure. Now, yes, I know some of you have listened to webinars before will understand that the ISP is trying to reduce disclosure. We're all trying to cut the clutter. We're all trying to get rid of all the gump that's in accounts. I still believe that. And I still believe that you should be reducing a lot of the disclosures and using those new materiality guidelines and that new materiality definition that kicks in this year to reduce your disclosures. But in this area, I think you need to see a lot. I would expect to see quite a bit around that. This is almost to me a bit like in 1999, where companies, or 1998, when companies were talking about Y2K. What scares me is there are probably some people out there who have no idea what I'm talking about. But yes, when there was the whole issue around the year 2000, almost every company had to comment on their readiness. I think this is a similar situation. We would expect every company to make a comment. Even if this is immaterial to you, I would expect you to make comments saying, we believe this is immaterial to us for the following reasons. On this slide, all I'm going to do is just recap the requirements for you to remind you of what we would expect to see in your accounting policies. I mean, the first one talks about disclosure of the judgments that management's made when it's applying the accounting policies they've got. That obviously has the most significant effect on the amounts that you've recognized. There, I'd want to see the judgments you've made around potentially the indicators you've got on impairment, or you don't believe the indicators of impairment, or your judgments you've made around the markets you're dealing with when it comes to impairment. And of course, your judgments there around whether you think it's an adjusting or non-adjusting event under IAS 10. As I said, if you've got a January or February end, I'd probably expect those type of disclosures there. So we want to see where the judgments that management's made that could significantly impact on what we've done in the accounts. Of course, the second one there talk about disclosure of any assumptions you've made about the future or other major sources of estimation uncertainty that could impact the numbers. Yeah, I think that's quite self-explanatory. I mean, I want to see disclosure around those, especially where you've done the numerical numbers, things like your impairment provisions, things like your adjustments to your impairment model under IFRS 9. I want to understand what estimation uncertainty or what assumptions have you made that I would need to understand in terms of that. So as I said, I would expect to see quite extensive disclosure in this area. As I was saying there, just what I'd spoken about, ensure proper disclosure of the areas of estimation and uncertainty that you've got there. I'd also comment on the relevant issues. So, for example, the impact of social distancing. How's that impacting on your business? Are people coming into work? Are they not? Are you in lockdown? So it's not always necessarily something that's just about pure numbers and macroeconomic issues, but also about the social impact. Social distancing is obviously having a massive impact on why all the cinemas have closed down. It's going to have, I think, a big issue on the viability if you look at things like the cruise ship industry that's in disarray. I mean, for myself, we were talking to friends last night and saying, how long do we believe it'll be before you're prepared to go to a crowded place on the weekend? And I think that could have a big impact even on retail and shopping centers. Are we going to all avoid busy times? So I think that these type of things could impact you depending on the industry you'd be in. I would just point out there that uncertainty is very high at the moment, okay? And I think that's going to be very difficult to get consistency across companies, which is why I think that the more disclosure you make, the less chance you're going to get caught out where somebody's going to say to you, hang on, you didn't tell us about this. In the past, people have been able to say, yes, well, you can look at any company or what's happening in the market. I don't think that applies anymore. I think this is impacting every market differently, every industry differently. And so I think you cannot just assume what people can know that if they read a newspaper. I think you need to make sure you put enough disclosure in there that people believe you've been honest, transparent, and very clear about the impact that this has had. So that's judgments and assumptions. And once again, if you're on the preparer side out there, I really do think you need to be starting to work on those quite carefully and seeing how you're going to put them in. Obviously, from the order point of view, I think once again, this is probably an area that you're going to spend a lot more time on than you would have in the past, just taking into account everything that's there. Last thing I just want to do is just look at some of the other areas that you may need to consider as you're going into year end. Just a couple of them I've listed there. The first one, of course, I-16 on property, plant and equipment. I think this could very much have an impact on things like your annual assessment of your useful lives, residual values, etc. of the assets. Useful lives could be impacted on the fact that factories are closed at the moment. Maybe this pushes them out. We've mentioned the impairment issue already, and of course the impairment issue could clearly show that some of these assets' useful lives have reduced substantially, or they're increasing. Also, maybe your depreciation method you've been using is unit of production. It's not really going to work at the moment if you're not producing. So just I'm saying you need to start looking at all these various bits and pieces. So there could be impacts there on the assets. IS2 inventories. Obviously, you need to assess the net realizable value of the inventories you've got. And of course, we are in an economic slowdown at the moment. So that could have an impact on demand for your products. We look at the obsolescence, see if anything needs to be written off. One other thing just to point out around IS2, remember when you're doing your overhead allocation, when you look at things like your fixed overheads and how you allocate those to it, remember we're always doing that on the basis of normal capacity. At the moment, there is no normal capacity. So I think there may be some P&L impacts there if you've still got those fixed overheads and potentially you're producing a lot less. You've slowed down your factory, you may not be producing. You just may need to spend a bit of time taking a look at your overhead allocation as well. So a few things to think about, especially if you're an inventory-rich company. IS37 provisions, of course, I think onerous contracts is another big one. Are you still able to deliver? Are your clients able to want what you're doing? Maybe you have an inability to deliver. Maybe you've got a lot more staff that are going to be sick. It's going to impact things like provisions for that. Maybe you're going to be laying people off and you're going to have retrenchment provisions. I think you will need to spend a bit more time just considering some of the major contracts and whether some of those are becoming onerous. That could happen, of course, in a number of areas, whether it's employment, whatever it may be, provisions, raw materials. So just spend some time considering those. Another one, share-based payments. Remember IFRS 2, this is going to have an impact on vesting conditions. Remember, of course, for certain types of your share-based payments, we're looking at things like you have to assess the probability of things vesting. I would anticipate that for quite a few share option schemes out there at the moment, they're all underwater, given that we've had such a major drop in global markets. I would anticipate that could have an impact, especially on those who are going to invest in the short term. So I think you'd need to seriously spend some time looking at your share-based payments there. And also things, just the last one, we'll about your loan covenants and breaches. There are going to be some cash flow constraints. We've seen a lot of companies coming out with cutting salaries, putting people on unpaid leave, all these type of things. Just be conscious that you will need to look at your debt. Are there any loan covenants where you're potentially going to be breaching those now? Would they need to be reclassified from non-current to current if those breaches have resulted in them becoming current? Have you discussed it with the banks, etc., in the right timing? Because remember, if you're doing that after year end, it doesn't impact your at year end classification. Just bear in mind that with all this impacting on you, there is going to be quite a lot of things to take into account. So where to from here? I think, in my view, I think the uncertainty is going to persist for a while. I will point out that's my personal opinion on this, but I think that even if the health issues start being resolved in the short term, as I mentioned earlier, I think it's going to take a while for the world to recover from this, which means I think that this uncertainty is going to persist. I don't think we also know how long or the impact it's going to have. I mean, just interestingly, I was reading an article the other day that was talking about the airline industry and saying one of the biggest challenges is that many companies are now realizing that things that they believe need to be done face-to-face can actually be done virtually. The ISP themselves are running their board meetings virtually again this month as they did last month. So, these were always face-to-face. And as we're starting to see people realizing that the technologies like Microsoft Teams and Zoom and all these things actually work very well in today's day and age of fast internet connectivity, that a lot of people are saying, well, we can save a lot of money. How's that going to impact on it? Secondly, I think your forecasts will become challenging as time goes on. Hopefully that we can get those right. But remember, you may be getting through the December or the March year ends, but as time marches on, you'll start, especially for the listed companies, to worry about your interims. I think just start giving thought to how you're going to relook at those forecasts. Just a simple rollover of last year is probably not going to suffice in the current economy. Thirdly, I think governments are going to get more involved. And I think as governments potentially get more involved with more stimulus packages or more support, we're seeing interest-free loans, secured loans. I think all of those need to be looked at and the impact of those. And also keep an eye on best practice. I would strongly suggest that you read the accounts of other companies, see what they're commenting on, see what your peers are making a bigger show and what they're not. Because I think that much like when we see a new standard come out, and it always takes a little while to get best practice, I think we're going to see that here as well. People need to resolve how they're going to deal with this in terms of how people are accounting for the numbers. I will point out that, as I mentioned, the ISP is having a meeting again in April, so please do bear in mind that if that does come out, if there are changes, we will push those through to you, and we'll make an announcement on the e-learning platform, and of course run webinars if those become required. So those are the accounting implications of COVID-19. As I said up front, this isn't an exhaustive list. There may be other areas that you need to take into account. We haven't spoken about things like IAS 19 that may be impacted, your pensions, etc. But yes, you will just need to look at that and see how it impacts on everybody. Thanks for joining me today. As I said there, please do stay safe. Look after yourselves, your families, and let's hope we will come out of this happy and healthy on the other side of it. I will stay online. If there are any further questions, please do feel to type them in, and I'll try and respond to all of them as we go along. Other than that, there will be a recording of this. If any of your colleagues missed it and you think it adds value to what they may be doing, it will be placed on the next couple of days onto the application, so use it from there. Thanks very much, folks. All the best. Take care.